Hey everyone, there's a growth stock that I've been following for the last 4 or 5 years or so that's down 82% off its high water mark. And I think that it's undervalued according to its current valuations. Now, I'm not just saying it's undervalued because it's down 82%. Sometimes stocks are down 82% and there's a justifiable reason why they're down, and they're not a stock that I would recommend. But this stock, it's down 82%, but I like where the company is going, and I think it's an undervalued investment given several of the critical metrics that I've evaluated that I'll share with you in this video. So follow along and let's take a look at what the company is and why I think it's a buy on this dip.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the stock I'm talking about here that I think is undervalued is DocuSign, the electronic signature company. It's down 81.73% off its high. The bulk of this decrease coming following the economic reopening. Of course, DocuSign benefited when people were spending more time at home, trying to stay 6 feet away from each other during the time when the COVID-19 pandemic was raging. But then when economies reopened, DocuSign's stock price collapsed. But the business didn't collapse. And so I felt that this stock price decrease has been an opportunity for long-term investors to scoop up shares of this company that has a nice long-run tailwind behind it. You see, electronic signature makes sense whether you're in a pandemic or not. Who among you wants to travel in person to an office to sign documents? Wouldn't you rather do it online? Wouldn't you rather do it electronically? It's a no-brainer, right? It's convenient for both sides of the transaction. And so over the long run, more and more signatures will be signed electronically, and that's the tailwind that DocuSign will benefit from. Already, its revenue over the last several years has grown to 2.81 billion. And you'll notice, even though you had that economic reopening, the company's revenue didn't collapse all of a sudden, right? It wasn't like, oh, electronic signatures make sense during a pandemic, but outside of a pandemic, they don't make sense. So we don't need you anymore, DocuSign. That's not the case at all. Electronic signature is a no-brainer. It makes sense. I can't think of anybody that would prefer to sign documents in person. Now, I will say there are specific cases with high security needs that you want to be in person, but those are rare. Those are rare comparing all of the documents that are signed worldwide. The amount that you need to have in person for security reasons are a relatively small percentage of that overall signature market. And so over the long run, more and more businesses will shift towards electronic signatures, and consumers will love that because it just makes more sense. And DocuSign is the largest player in this market. According to Statista, DocuSign held a 67% market share in electronic signatures in 2023. 67% market share in 2023. Now that's come down somewhat in 2024 when the numbers come out. I wouldn't be surprised if DocuSign's market share is down a little bit from this number, but still it's one of the largest players, if not the largest player in this market. So it's the one that's going to benefit the most from the rising percentage of signatures that get signed electronically over the long term. And the company has grown in profitability. Its operating profit margin, you can see rising all the way up to 3.19% from negative levels in 2019. Since it's a software business, I wouldn't be surprised if these margins continue rising towards 30% because the company doesn't need to spend money on each signature. You think of it this way, they spent a great deal of money on the research and development to develop this technology, and then they will need to spend money on research and development to maintain and enhance and upgrade the technology, but not as much as was needed in the initial growth phase, in the initial building of the business. So now it's time to reap the benefits from all those investments the company made earlier in its history to build out this technology, to prove the technology, to get businesses comfortable with the technology for them to switch over to electronic signatures. And when you look at its cash flow from operations to sales, that number is much, much larger at 35.61%, and that's up from a little over 8% in 2020. 35 out of every $100 the company makes in sales turns into cash flow. That's a really positive number. The difference between cash flow and operating profit margin for DocuSign is stock-based compensation, which is a non-cash expense. The company pays that out to employees instead of giving them cash to incentivize them to do their best work. Now, if you look at the next 5 years, the analysts on Wall Street expect DocuSign to grow its earnings per share by 20% per year over the next 5 years. Now, this is not turbocharged growth. This stock is not one that's going to double your money in the next month, but it's a steady grower benefiting from a long-running tailwind that's expected to continue growing its profitability as economies of scale start to reap for DocuSign. Additionally, the company's balance sheet is absolutely pristine with $1.1 billion in cash and short-term investments and zero long-term debt. Now, for a company like DocuSign, having a pristine balance sheet can offer many benefits. For instance, it can offer its customers favorable credit terms because DocuSign is not desperate for cash, so it can tell its customers, it's fine, you can pay us back in 3 months or 6 months if you need some leeway in payback. Or DocuSign can use this cash to buy back some of its shares outstanding to reduce the share count and increase the earnings per share. Regardless, having a pristine balance sheet offers flexibility for DocuSign and its investors. And the return on invested capital continues improving, 7.69% in the most recent period. That's up from negative 20% in 2020 when its profitability was negative. Return on invested capital measures how good a company is at using investor funds to generate sales and profits and cash flow. And that's where investors reap the most benefits from investing in a company, is when management is good at using the money to create products and services that generates profits. If management is wasteful with the money that investors give them, then this return on invested capital number would not be positive. It would not be increasing. And finally, given the share price drop, DocuSign is trading at a relatively cheap valuation, a forward price to earnings of 16.3. Now, a general rule of thumb I like to tell my viewers is that if you have a forward price to earnings that is lower than the earnings per share growth rate expected over the next 5 years, that is generally a evidence of a bargain stock. Now, you can't just look at this one metric and say, oh, it's a bargain because the forward PE is lower than the EPS expected over the next 5 years. You can't do that. You can't look at it in isolation. But when you look at all of these other things that I've shared with you, and on top of that, you have this metric that's larger than the forward PE multiple, then it's sort of a confirmation that you found something undervalued. And I agree with this case for DocuSign. It does signal that this stock could be an excellent undervalued growth stock that investors can buy now and hold for the long term. Now, I will highlight that competition could come in and take DocuSign's market share, as I highlighted a little bit in the market share segment. But because this market is not a massive and growing massively market, right? I shared with you, it's not going to double overnight. It's not one of those trillion-dollar market opportunities. And so you're not going to have very many competitors that are interested in entering this market. So it's mostly going to be players within the industry already that are competing for market share. And so for that reason, you have some protection against competition, but DocuSign doesn't have some differentiation that will protect it against, let's say, Adobe coming in and taking market share. So though that's the biggest risk I see with DocuSign, other than that, I think the stock is an excellent long-term investment. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.